Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Eli Lilly stock so we can determine if it's a buy or a sell. Eli Lilly is a pharmaceutical company. Its products are sold in 125 countries. Some of the products they're known for are Prozac, Cymbalta, Zyprexa, and Trulicity. It was the first company to mass produce the polio vaccine developed by Jonas Salk. In 2009, the company pleaded guilty for illegally marketing Zyprexa and agreed to pay a $1.4 billion penalty that included criminal fines of $515 million, the largest ever in a healthcare case, and the largest criminal fine for a corporation. Last year in 2022, the company's market cap fell $20 billion. This all stemmed from someone's Twitter account making a false announcement about insulin sales ending in November 2022. In response to public pressure and increased competition, the company took action to make insulin more affordable, implementing cost caps and price reductions. The company is headquartered in Indianapolis, Indiana, and was founded in 1876. Let's get started with the model. This is a large cap company, 413 billion market cap. They're trading at $4.35 a share, and they have 948 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do have lots of free cash flow each year. It grew a lot from $3.5 billion to $5.4 billion. It came down in 2022 to $4.6 billion. Net income is a profit or loss on the income statement. It's revenue minus expenses. And that increased from $4.6 billion to $6.2 billion. Revenue is a sales for the company, and that grew a lot from $22 billion to $28 billion, but it's pretty flat from 2021 to 2022. They did release their first quarter earnings. This is the first quarter of 2023 compared to 2022, and their revenue was $7 billion. I'll give you a breakdown of that number. Their revenue declined in the US from $5.2 billion to $4.4 billion. It went up in Europe a little bit. It's currently $1.1 billion, and it looks like it's down in every other country. Japan, $387 million, then China, then all other countries. In the US, 1/3 of their revenue comes from one drug, Trulicity. This is for diabetes. It's also the biggest revenue generator outside the US, $429 million. Of their total $7 billion of revenue, $4.2 billion comes from diabetes drugs, $1.4 billion from oncology. Oncology is a treatment of tumors and cancer. Then you have immunology, $780 million, neuroscience, $361 million, and $275 million in other. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. For example, all the expenses to manufacture the medicines. Research and development is always going to be big for this company, $2 billion. That's mostly the payroll for all the man hours to research and develop new vaccines and drugs. But it's not just new vaccines and drugs. Sometimes it could be to improve a current vaccine or drug. That's also part of R&D. Marketing is $1.7 billion. So total expenses $5.4 billion. Operating income $1.5 billion, net income $1.3 billion. So their EPS is down from $2.11 to $1.49. They do buy back stock. They had more shares outstanding in 2022 than in 2023. Let's look at the capital structure. $11 billion of equity, $16 billion of debt. They're 40% equity, 60% debt. Net debt is $14 billion, so they have about $2.2 billion of cash on their balance sheet. They have a WACC of 8.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $209 billion. We discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $177 billion. We divide that by 948 million shares. And we get a calculated stock price of $187. They're trading at $4.35, so they're trading at a 133% premium. It's a sell according to the model. Simply Wall Street is at $373. They're saying they're 17% overvalued. 16 analysts price this stock, and the average price target is $415. The low is $270. The high is $505. 23 analysts price this stock, and the average price target is $409. They're saying it's 6% overvalued. This is where the stock has been trading the last 21 years. The stock was a lot higher in 2001 when you compare it to 2009, 10, 11, 12. It got pretty low, and then around 2019, it grew exponentially. It does make you sad when you see this big run up, but how would you know? I mean, it's really got to come down. I mean, look at this growth. It's unbelievable. It just keeps going up. Since 2002, this stock is up 460%, while the S&P is up 260%. And the S&P was outperforming this stock pretty much from 2002 to the beginning of 2021. The S&P was easily outperforming the stock, but then it just shot up. They doubled their dividend from 56 cents to $1.13. It's a yield of 1%, 93% of their free cash flow, 69% of their net income. There are 15 companies in the same industry as Eli Lilly, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spend a lot in CapEx, $2.2 billion, half of what Johnson & Johnson and Merck spend. They have a pretty weak debt-to-equity ratio. It is better than average, but a lot worse than the median. They pay a pretty low dividend, only 1%. Their free cash flow is lower than average. They're almost as big as Johnson & Johnson, which is just crazy. If this really deserves to be $400 billion market cap, which it doesn't, then Johnson & Johnson should be $800 billion. But I think J&J is priced appropriately. This stock is just really overvalued. Look at their price multiples. So much worse than the median and average. And they only generate $29 billion of revenue. Johnson & Johnson is more than triple them. Merck is double their revenue, and Merck has a lot smaller market cap. And they're only growing at a 7% annual revenue growth rate, so it looks like the growth has peaked. I think this is a good stock to short. So to summarize, this company has been around 137 years. I think there's very limited upside, but a great chance for downside. But some people like to hold this stock because you get your consistent dividend. It's only 1% though. I have them trading at a 133% premium. I rank their free cash flow as 5 out of 10, their revenue 6 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. Also, if you'd like to be a member, you can click on the link in the description below. Thanks for watching.